And the reason I started buying those is because I was doing it myself and just picking different ETFs, but then I was fiddling with it too much. And every time I logged on, I was like, oh, should I buy like this different one instead? Or like, what about this? Or like, should it be 30% Australia or 35% Australia? So by buying the all-in-one diversified one, I just like stopped messing with it.
The Get Rich Slow Club podcast is a collaboration between Tash Etchman from Tash Invest and Anna Christina from Perla. The Get Rich Slow Club acknowledges the traditional custodians of the land we record on. From coast to coast, across land, waters, and communities, we pay our respects to elders past, present, and emerging. Any advice is general and does not consider your financial situation, needs, or objectives, so consider whether it's appropriate for you.
Welcome to the Get Rich Slow Club podcast,
where we take you from beginner to confident investor,
where we can teach you everything you need to know about investing.
So come get rich slow with us.
Hello and welcome back. Today we're going to be comparing two of some of my favorite, but also two very popular ETFs out there. VDHG, which is the Vanguard Diversified High Growth Index ETF, and DHHF, which is the BetaShares All Growth ETF. But first, before we dive into the fun of the two different diversified ETFs, let's talk about our money wins. Should I start?
Sure.
I was rotating through all the meal delivery kits about 6-ish months ago because I wanted to sign up to all the free boxes to get free food. So like Dinnerly, HelloFresh, there's Marley Spoon, and Every Plate. I cancelled them all after the free trials, and I've just gotten all the kind of text messages and emails offering more sign-up bonuses. So I went back to Dinnerly and I got 3 dinners for $39 delivered.
Oh, I love that. And it's always great in certain situations where you sign up to something and then you don't purchase it, and they'll follow up also with a, hey, you get 20% off your first sale. Like if it's something that you didn't purchase, taking advantage of those sales when you're already going to buy something is so important.
And I was trying to find a way to hack the discounts because usually it doesn't let you have them again if you've already had them, because I really wanted to get some kind of meal delivery again. I found I was eating so much healthier when I was doing it because you get the like meals straight to your house. You don't have to think about it. But then they magically just emailed me. So I was like, great, good timing.
Oh, they did? Yes, great. Because the other option is maybe changing your email. Would that work?
But I've done it already.
Oh, you've done it.
And it knows by your address. I think we've just moved, so like that would be okay. But I was trying to do it back at our old place as well. And it like knows that you live there.
Yeah, fair enough.
They're too smart, and it's like the same credit card, the same, they like pick up on everything.
Yeah.
What about you? Do you have one?
So because we are recording in the past, so by the time this comes out, this might be a little less timely, but my mom went and made the kids Halloween costumes.
Oh, what did she make?
She made pumpkins, which you could totally buy at Kmart.
Yeah.
You know what I mean? But every year I've dressed them up as food. And this year they're a pumpkin, which is very Halloween-ish. But in the past, they've been fairy bread and donuts and burritos. So
amazing.
Yeah,
I love
why
it.
not?
A burrito. Perfect.
I also love Halloween. Like I love that it's picking up more popularity. I know it's like a very consumeristic kind of thing. Again, candy, spending money, costumes, but there's something nostalgic about it for me. So I love it.
Amazing. So fun.
And it looked really cute.
Yes, I'm sure. I'm trying to imagine the burrito. That would be so adorable. The pumpkin as well.
It's because it was when I had a newborn. So so it just wrapped up.
Yeah, I love it. DIY costumes.
Yeah, for sure.
Back to diversified ETFs. So before we dive into the pros and cons and the differences between the two, just to clarify, they are high growth diversified ETFs, which means they are a basket of shares or a basket of ETFs that hold other ETFs or other funds in them. And they are high growth, which means 7 or more years.
Yeah. And high growth also means that it is a little bit more skewed to the growth aspect and less so to the defensive assets, which are cash and bonds.
So we'll talk about asset allocation first. DHHF I quite like because it is entirely allocated to shares. So it is a 100% exposure to global and Australian shares. This makes it more ideal for people seeking that high growth investment and are willing to just have an all share portfolio. It's globally diversified, so it's in the US, Europe, Asia, and emerging markets as well. I like it because I have cash in my savings account and I don't really want to buy bonds myself. So I like that it's not automatically included in the ETF. It doesn't mean you can't go and buy it yourself outside of the ETF, but that's why I quite like that one.
Then there's VDHG, which on the other hand has a diversified portfolio that includes approximately 90% equity, so those high growth ones, and 10% fixed income and cash. So this allocation offers a bit more stability compared to DHHF. thanks to that small bond exposure. But like DHHF, VDHG's equity exposure is global with a portion allocated to Australian shares.
They have a very similar allocation to Australia when I've looked at them previously. But let's talk a little bit about their structures. So VDHG is structured by holding underlying managed funds, but DHHF has underlying ETFs. So VDHG has 7 managed funds that make up the ETF. Gosh, so many words for this. Whereas DHHF has 4 ETFs that make up that ETF.
So let's talk about what that means. So if DHHF holds ETFs within it, which is it's a bit more tax efficient than the non-ETF funds held by Vanguard. However, DHHF does have some tax drag due to its US domiciled holdings.
So this means it's hard if you've got, so sometimes we have ETFs that are like on the ASX and it like the tax and the currency and everything is just Australian, which makes it easier. Sometimes we buy ETFs that are listed or domiciled in the US. We do have to deal with the US tax system too. Usually that's fine. There's forms you can fill out or the ETF providers will do that, but it's just like a small consideration to add on to there.
Yeah.
But the reason you would buy a diversified ETF is because instead of buying the 7 managed funds yourself, you just want someone to buy all 7 for you in the one fund. So it may sound confusing where like there's 7 in this one and it makes this one great fund, but it's so you don't have to go and buy them individually yourself.
Yeah. So individually, what that would look like is, for example, having one that's focused in Australia or having one that's focused on international. Like that's what we mean by having those funds within the one fund.
Mm-hmm. So what's the difference between the risk profile and volatility?
So DHHF is 100% equities. So again, it has a higher risk profile and will likely experience more volatility, especially in downturns. And the high risk profile is suited for investors who have that long-term horizon and can ride out those market fluctuations.
VDHG is considered slightly less risky or to have slightly less volatility because it has 10% in bonds and cash. So defensive assets like bonds and cash are meant to kind of try and smooth out market fluctuations. But again, it is only 10%. So it's not like half of the fund like a balanced one might be. It's still a growth fund.
So let's talk about fees. The fees for DHHF is around 0.19%, also known as I always laugh at this.
19 basis points.
19 basis points. Yeah.
If you see that written somewhere else, perfect.
Yeah, 0.19.
VDHG is a bit higher at 0.27 or 27 basis points. So a little bit more expensive.
It is funny when you think of basis points, like the terminology, but nonetheless, it's important to know the different fee structures.
Yeah, I think it like 0.27% isn't that high, especially when you consider there's 7 funds in the Vanguard one. So if you were buying DHHF and then buying bonds outside of it, you would need to pay your own brokerage fees and stuff like that. So it's kind of considering there's more in the VDHG one.
It's still fairly low, relatively speaking. And then in terms of portfolio rebalancing, DHHF is again, an all equity fund, and it doesn't require rebalancing across asset classes, but it does automatically get rebalanced within its equities exposure to maintain the intended geographical allocations.
VDHG does rebalance across both equities and bonds as well. So Vanguard automatically adjusts the asset allocation over time to make sure it is still 90% equities and 10% bonds. Shares or equities tend to grow faster some years than bonds will. So they will have to sell down some of the shares that are performing to then rebuy bonds to maintain that allocation.
If this sounds confusing, I mean, the idea is that you don't have to think about reallocating your portfolio. And this is really beneficial to those people who are looking for long-term investing, really passive, simple. They want to just take a step back. Both of these funds are one of those ones that you can kind of sit back and you don't have to think about it. Whereas if you are investing yourself in various ETFs, such as one that's focused on Australia, one that's focused on US, and one that's international or high growth or bonds or whatever it might be, there's a lot more rebalancing that you might think about, whereas these funds do it for you.
And they're both good options. If you want a good long-term investment for 7 to 10 plus years and you have a high risk tolerance, these are both good options. We're just comparing them both because sometimes people can get a bit stuck, I found, on like, which one is the best? Do I buy the Vanguard one or do I buy the BetaShares one? Like what is even the difference? That's what we're doing now, but like both are generally good options. So for returns, DHHF is a relatively newer ETF. I think Vanguard, the VDHG one, is as well. So I've only got the 1 year and the 3 year returns, but the 1 year returns are quite even. So DHHF was 21.54%, whereas VDHG was 21.22%. So like 0.3% difference, like pretty on par there. But the 3 year return is where it gets a little bit different. So DHHF is 8.54%, whereas the VDHG one is 7.18%. So what is that, 1.3 something less? This is because there is that allocation towards bonds. It's not just all shares.
Yeah. So it kind of it evens out the volatility a bit. But that just means that your investments may be a little bit safer due to those bonds and the cash.
Yes. But then again, it is only 10%. But yeah.
Yeah, exactly. The other thing that's worth noting is the number of companies that are in each of them. So DHHF has around 8,000 companies, whereas VDHG has 16,000 companies. So essentially double.
Yes, but the percentage allocated to those companies would be really tiny. So most of these funds hold pretty much the same stuff with the larger percentages. And then as you go down like the index and the market caps, it gets less and less allocated towards it. So there is more diversification, but yes, it isn't like they're equally weighted where it's like every company is the same amount in the ETF.
Yeah. And for people who don't know what equally weighted means, it just means like the percentage allocation. So that's another term that gets thrown around, weighted or allocations. It's kind of the same.
Mm-hmm. Do you buy any of these?
I don't, actually. I don't have either. I did have a friend reach out to me a while ago and he was saying, I'm choosing between these two. Which one should I choose? I'm really confused. Like they both sound good. I don't know. And I think most of the time it's like much of a muchness. Like, yes, there is a bit of a difference in terms of the number of companies. There's a bit of a difference in terms of one being 100% growth and the other one just being 90% growth. The fees are similar. The returns are quite similar. I think that holistically, these are great all-in-one options.
I started by buying VDHG initially, because this was a little while ago now. And then BetaShares came out with this all growth one and I ended up switching. I still own my VDHG, but now I buy the DHHF one because I liked that it didn't have bonds in it.
Yeah.
And I'm still like, I'm 27 now. I don't really want to buy bonds anytime soon. I have got cash and other things outside of it. So that's why I chose to buy the all growth, the all shares one. But like VDHG is tempting because it is like that slightly more diversified one.
Yeah.
And the reason I started buying those is because I was doing it myself and just picking different ETFs, but then I was fiddling with it too much. And every time I logged on, I was like, oh, should I buy like this different one instead? Or like, what about this? Or like, should it be 30% Australia or 35% Australia? So by buying the all-in-one diversified one, I just like stopped messing with it.
Yeah, you just got it and you're done. Well, it's funny because I ended up asking my friend, I'm like, so what did you land on? Like, what was the choice?
Yeah.
So guess what it was?
VDHG?
Both.
Oh, okay. Interesting.
So I think you've gotten asked this quite a bit. I know I have. It's like, well, I don't know which one to choose. I'm just going to buy both. And often if you buy both, you're literally holding the exact same thing. So why?
Yeah, like 90% the same. I don't know if it is 90%. I'm pretty sure it would be like very, very, very similar. But if that's what you need to start investing, then
sure. Yeah.
Because then you've just essentially made it that you've got like 95% shares and 5% bonds if you've bought equal amounts of them. So you're like, sitting in the middle, I guess.
And similarly to you, I've done the same thing where I've like bought a whole bunch of things. I hold a whole bunch of ETFs and now I only invest in one or two. And that means that the allocation of everything else gets smaller. In the same way that you started out with VDHG, you're now investing in DHHF. Your allocation that's to VDHG is smaller. I mean, obviously there's overlap in what companies, but that's just another thing. That's the cost of learning, right?
Yes.
You make mistakes or not, or maybe it's not a mistake. It makes you sleep better at night, whatever works for you.
And it's hard if you're like just looking at a screen being like, oh, 7 versus 8% or whatever it is. But if you buy both of them and you see one doing better than the other, then you're like, oh, why is that happening? Do I want to buy that one instead? Might that change? Like I think starting is always a great idea. So none of these are bad options.
Yeah.
Unless you want to only invest for 1 year, then it might be a bad option. But if you are looking for a high growth, long-term investment of 7+ years, these are both like decent options.
Yeah, absolutely.
Perfect.
Okay, thanks.
Bye.
Bye.
Thanks so much for joining us. If you found this episode helpful, please rate us 5 stars, write a review, or share with a friend. If you're new to investing, make sure to listen to our first 10 episodes. Follow us at Get Rich Slow Club or Tash at Tash Invests or me at Ana Cristina.
This show was brought to you by Natasha Etchman, who is an authorized representative 1299881 of Guideway Financial Services, AFSL 420367, and Perla, who is an authorized representative 1281540 of Sanlam Private Wealth, AFSL 337927. Knowledge is power, especially when it comes to investing. So make sure you check out our financial services guides and read the product disclosure statement and target market determination for any investments you're considering. See our show notes for more info.